This is Nick Kristof with the Kristof team, and I wanted to do a quick update for you today to answer a question that I've been getting a lot of lately, and that is, should I wait to buy? Interest rates are at 20-year highs. Should I wait to purchase the home because rates are so high? And I wanted to give you an update because just this morning, the Wall Street Journal put out an article. I put a link here in the email so you have access to it, but they put out an article, the headline, and I'll quote it, "The fall in home prices may already be over. The quick recovery in price suggests housing downturn could be shorter, shallower than expected." So for many of you, this is what you're expecting anyway, but it is key that the Wall Street Journal is now sharing this information kind of to the broader public. And in particular, there was a quote in here that really jumped out. A panel of more than 100 economists and housing analysts surveyed by Pulseonomics in March expected home values to fall about 2% year over year this year. When surveyed in August, the panel predicted that prices would rise 3.3% this year instead. So that is a pretty significant reversal in where their expectation of where home values are, and it's all driven by the thing that we all know, and that is a shortage of inventory. And so the key part I wanted to share with you today, beyond just kind of passing along that article, is just some basic math of it as it relates to mortgage loans. So not opinions on the market, just taking the information in the article and doing some quick, literally back of the envelope calculations here to kind of show where that break-even point is and why it may not make sense to wait just from a purely mathematical standpoint. So I'll take one example here, a $500,000 home. And if we take the math that was in the Wall Street Journal article and say a year, 3.3% appreciation or rise in price, that math is $516,500. So a $16,500 increase in price equating to 3.3% rise. If we take that exact scenario today, it's $500,000 and someone's doing a 20% down mortgage, right? So a $400,000 mortgage. And we say, all right, let's answer the question. Should they wait a year, for example, and buy it, even if there's a 3.3% rise in rate, or should they buy it today? Which one is the more cost-effective approach for them? And the example I'm going to do, I'm going to highlight this in a bit of an extreme example. I'm going to say, what if, hypothetically, rates were 10% today for that mortgage? 10% for that mortgage. I can't speak to every situation, but most are not. You know, a prime borrower, 30-year fixed rate scenario is probably in the 7s or even high 6s, not 10%. But let's just say, for argument's sake, that you have a mortgage rate of 10% on $400,000. Does it make sense to buy it today at $500,000 or wait and buy it in a year at $516,500? Well, the difference in payment is about $1,363 between a 10% mortgage, 30-year amortizing, and a 5% mortgage if it dropped all the way back to 5% a year from now. So we have a massive swing from 10% to 5% in 1 year in mortgage rates. And we're going to take the straight number they have in the Wall Street Journal article of 3.3% for an increase in home prices. Well, the interesting thing, if we take that 1,363, so 1,363 difference in monthly payment, multiply it out by 12 months in a year, we end up with $16,356. So the difference, if you were to wait and have a 5% mortgage versus having a 10% mortgage, is the equivalent of $16,356 per year. Well, we just said the home appreciation was $16,500 just in that 3.3% appreciation in the actual home value. So literally in 1 year, the break-even point, if you were to buy it today at 10% and rates were to fall to 5%, you still come out ahead in a 10% mortgage rate compared to just 3.3% of appreciation in that scenario. And you can multiply that out. If it's $1 million home or $1.5 million home, all of a sudden these numbers get even more magnified. But the example here is really just to show that if you are looking at whether to wait or buy, the money is going to be made or lost on the home purchase. So you as an agent, you're in the position of saying, hey, here's what we expect on markets. Here's what you see in terms of what's going on in the market for the real estate. The mortgage rate is going to be perhaps temporary in nature, or even still a small portion relative to that overall home value. So in this example, like I said, 10% mortgage, it still comes out ahead in the 1-year timeline to buy the home today at the $500,000 price and a 10% mortgage, rather than waiting a year from now and buying it at a $516,500 price, even at a 5% mortgage. The other piece that's relevant is you can probably refinance that mortgage in a year from now if rates go. And I don't know every situation, but I'm certainly an expert in mortgages, and it probably would be a conversation I would having with a customer to say, hey, you're at a 10% rate, it's gone to 5%, it may be worth looking at refinancing. So even something like that, if they're buying the home today at that price, there's a huge amount of savings that can be made up if rates do fall that dramatic amount. But even if they don't, and they start at a 7% rate, they're still coming out ahead based on where those home appreciation values are. So anyway, I just saw the article. It's been exactly what conversations I've had lately with so many customers. I thought it would be relevant to share with you. If you've got more questions or want to drill in, or you've got customers that want to do that math to run that scenario, feel free to reach out to the Christoph team. Thanks so much.